All right, today we're diving into something that sounds, well, impossible. We're going to crack open the actuary's secret and figure out how insurance companies take something as unpredictable as our own mortality and turn it into a steady, reliable profit. I mean, how do you even do that? How do you build a stable business on something as fundamentally unpredictable as life and death? It sounds like a total paradox. But here's the secret. For actuaries, it's not about predicting what happens to one person. Nope. It's about understanding what happens to thousands of them all at once.
Okay, so let's get right into it. The whole engine that drives insurance profit, or, loss, boils down to this one simple idea: the gap between what a company thinks is going to happen across a huge group of people and what actually ends up happening.
And this right here, this is the entire business model in a nutshell. An insurer uses these super complex models to make a really, really educated guess. So they might look at a group and say, okay, based on our data, we expect 100 people in this group to pass away this year. But then the year ends and the real number, it's only 89. And that difference, that's where the whole story of profit and loss really begins. Now look, this gap between what's expected and what's real can pop up in a few different places. Maybe the company makes more money on its investments than it planned for, or maybe a bunch of people just decide to cancel their policies. But for today, we are laser focused on the big one, the most fundamental of them all: mortality. So, how do these companies actually measure this mortality gap with pinpoint accuracy? They don't just count the number of people. It's more sophisticated than that. They calculate the financial impact using a concept they call mortality strain, and it all breaks down into three key calculations. Yeah, these three terms right here, DSAR, EDS, and ADS, they are the essential building blocks for any actuary. And I know they sound super technical, but trust me, the idea behind them is actually really simple. Let's just walk through it one step at a time. First up, we've got the death strain at risk, or DSAR for short. Here's the best way to think about it. For every single policy, the insurance company is setting money aside in a little pot, a reserve. Now, if a person passes away, the company has to pay out the full benefit, which is almost always way more than what's in that little pot. The DSR, that's the difference. It's the extra cash they have to find, the true financial hit the company takes for that one single death. Okay, so once you have that DSAR number, the next step is to look at your original assumption. Let's say the company expects 100 people to die. Well, they just multiply the DSAR by 100, and that gives them the expected death strain, or EDS. This is basically the company's budget for death claims for the year. It's the total amount they plan to pay out. And then, of course, the year ends, and the company has to look at what really happened. If it turns out only 89 people actually passed away, they do the same math, multiply the DSAR by 89, and that's your actual death strain, or ADS. This isn't the plan anymore. This is the cold, hard reality of how much they actually paid. So you see where this is going, right? It all comes down to this. Mortality profit is just the difference between what was expected to happen and what actually happened. You just take the expected death strain and subtract the actual death strain. It's that simple. It's the financial measurement of that gap we talked about right at the start. All right, theory's one thing, but let's make this real. We're going to use a super simple example from our source material to see this in action. Let's imagine we've got a portfolio of 10,000 identical life insurance policies. So check out how these numbers work. Each policy is set to pay out $50,000. And for this simple example, that's our DSR. The company assumes a 1% mortality rate, which means they're expecting 100 deaths. You multiply that out, and their expected strain, their planned cost, is a cool $5 million. But as we know, in reality, only 89 people passed away. So the actual strain, the real cost, ended up being just under $4.5 million. So you do the simple subtraction, right? The expected $5 million minus the actual $4.45 million, and there you have it. A mortality profit of $550,000. And that profit exists for one reason and one reason only. Fewer people died than the models predicted. So the logic seems pretty straightforward, doesn't it? Fewer people dying, that's obviously good news for them and their families, and it's also good news for the insurance company's bottom line. It's a win-win. But what if I told you that's not always the case? So fewer deaths always equals more profit, right? I mean, it feels totally intuitive. But the world of insurance has this fascinating twist, a scenario where the good news of people living longer can actually become very bad news for business. For regular life insurance, the rule we've just gone over is absolutely true. The business makes money when it pays out fewer death benefits than it budgeted for. Simple.
But then you've got annuities. And with annuities, the entire model gets flipped on its head. For them, fewer deaths actually means a financial loss. So what is an annuity? And why is it so different? Well, because it's basically the mirror image of life insurance. An annuity is a product that pays you for staying alive. The company isn't betting on when you'll pass away, it's betting on how long you'll live. And it has to keep cutting you a check for as long as you're around to cash it. And our source material gives us a perfect, real-world case. There was a company with a portfolio of 5,000 pensioners. Their models told them to expect about 10 people in that group to pass away that year. But in reality, only 9 did. That one-person difference, that single person who lived longer than the plan accounted for, meant the company had to keep paying out an income it hadn't budgeted for. And the result? A mortality loss of over £210,000, all because people were, well, healthier than expected. So what we're seeing here is that this core logic, this tug of war between expectation and reality, it's the absolute foundation of this whole business. But the cool thing is, it doesn't just work for simple individual policies. This is a tool that can be scaled up, way up. And this is really the key thing to remember. It doesn't matter if it's a basic term life policy or some super complex financial instrument. The analysis of profit and loss always comes back to this fundamental comparison of expected versus actual. I mean, actuaries apply this exact same framework to these huge portfolios with millions and millions of policies. They use it for much more complicated stuff too, like a joint life policy that pays out only when the first of 2 people passes away. Yeah, the math gets way more complex, for sure, but the underlying method, calculating that DSAR, the EDS, and the ADS, it stays exactly the same. And that kind of leaves us with one final big thought. We've just seen how actuaries can take the most profound human uncertainty and model it with this incredible financial precision. It really makes you wonder, right? What other risks that feel totally random and unpredictable in our daily lives are being quietly and constantly calculating, shaping the world all around us in ways we don't even see?